Ladies and gentlemen, please welcome my guest, Chris Naugle. Thank you, Chris, for being on the show, man. Thank you, boss. Grab a seat, brother. We got all kinds of stuff to cover today, and I know that you have an extensive background in business, money, which I got you on the show because of the money, right? And of course, a unique one is snowboarding.
Yes.
That you have as well. So I want to dive into all that stuff. We got 2 books that you've written as well. I'm going to go through that stuff with you throughout the show here. But before we go into all that stuff, let's get the crowd to get to know you a little bit, the viewers to get to know you. Give me a 30,000-foot view here. Like, how did you get started? How did you get into entrepreneurship, business in general? How did all that take place?
So when I grew up in a really lower middle class family, and we never had any money. So I always had to go out and do things like shovel driveways, mow lawns. I was a big dirt bike kid, so if I wanted a dirt bike, that's what I had to do.
Dude, I did that one too.
Yeah, so at 16, I got my first big boy job. I was working at a restaurant. But that restaurant owner degraded me so badly that I literally was clinically depressed.
Really?
So one day I came into work and I just quit.
Okay.
I quit trading hours for dollars. Came home, I said, Mom, sorry, I quit my job, but I want to open my own company. And that's where it all started. It was Fat Clothing Company, P-H-A-T.
P-H-A-T.
16 years old, started it in Mom's basement, and that was basically Fat Clothing really was designed to fund my snowboarding habit. Because I was trying to be a pro
snowboarding?
I was.
You were already snowboarding at the time? So you overall, you grew up in a little bit lower class family, which is kind of what maybe attracted you to the creating money or finding out how money works and so forth?
I think the snowboarding thing is kind of where that was like everying to me. That was my dream. I wanted to be a pro snowboarder, and to do that I needed money. So I had to connect the dots.
Where did you grow up at?
Lockport, New York.
So you grew up in
Tiny
New York.
little town.
Was there snowboarding in New York, in that area, or did you have to go other places? Because I think in New York it's more of a flat type of place there.
It is. You know, a lot of people say that. How did you become a pro snowboarder from Buffalo, New York? Well, you went where the snow was. We had little hills. I mean, they were hills, but we had really good jumps. So that's, and also I had a country club. And this is, I don't tell this often, but there was this country club by my house. And there was hills, and you know, there's the little sand traps.
Sure.
So I would go there. I'd have Mom bring me there after school. Golf course.
Oh, cool. Okay.
So I would build jumps out of the sand traps.
Wow.
And I would have Mom drop me off there, and after school I would just hike it and drill and practice all the tricks that I've seen in the magazines over and over again until I got it dialed. Mom would come get me before dark, and that was kind of how I did it.
What made you go snowboarding versus skiing?
That's a good question. I did try skiing one time, and I just didn't feel right. I was a skateboarder too. You know, I was a big skateboard kid. So skateboarding and snowboarding was a little bit more natural. A little
more similar to each other, right? I know you went pro in snowboarding, right?
I did.
How old were you when you first went pro?
17 years old.
So you went pro 17 snowboarding.
Correct.
When did your career end, snowboarding?
I say it ended at 35, but I think that's a little mental. It probably really ended around 33.
So 35, 33, your dealer's choice there.
At 35, I had a bad accident in California on a big jump, and that was it.
When you went pro, I'm assuming you were traveling. Was that like involved in X Games or touring? What was that? Yeah,
so back then it was a series called USSA. And that USSA is now the training grounds for the Olympics. And it's kind of all combined.
That's involved, because we were about the same age. And when I flash back to a kid, and I grew up in the South, but I don't remember like X Games being massive back then in my childhood. Was it big though, and I just didn't see it, or was it still like evolving and developing still?
You're absolutely correct. So there was like the U.S. Open, which was the big event back then, and that was a Burton event. But X Games was just starting to happen, and you know, I saw the whole invent of X Games, and I rode in one X Games in Stowe, Vermont.
Okay.
But yeah, it wasn't a thing back then. It was kind of just like somebody got this idea, we're going to do this massive event called X Games. And
when you went and you became pro in snowboarding, I'm just trying to figure this out. Was there a ton of money involved? Like, was there a big salary, or like?
No. I
think about going pro in baseball or pro in basketball. There's like tons of money. In that sport, was there a ton of money involved?
Not at all. I think at the peak of my career, I was making about $30,000 plus endorsements and video and photo credits.
So it wasn't like you were becoming a multimillionaire through snowboarding, and that's how you launched your business or whatever.
The top riders back then were making about $250,000, and I remember looking at those guys and saying, "Wow, those guys are rich."
Yeah, yeah. So last question, snowboarding here. I'm assuming that means that you did flips and you did like stunts and stuff, like jumps per se.
That's what I was.
Really, is that what you were doing?
Yeah, I was
not just going down a hill. You were doing
no.
more jumps and backflips and so forth. What was the best trick you had?
In my day, my staple trick was a cab 7 cork, which is going the opposite way. You spin 720, but off axis.
720. Yeah. Spinning. Up or upside down?
Well, you're kind of sideways, almost upside down.
Okay.
And then there was the rodeo flip, which kind of came out like in the middle of my career, and I really got that one down.
Yeah, because that's like all, like, you guys were like inventing stuff.
It was all brand new.
Right? Like every jump was like, let's create this and create this. On the different jumps and styles and so forth, right?
That's what was so fun about it. Is back then, like, you'd see one of the pros, like a Jamie Lynn, do a trick, and you're like, I've never seen that.
Yeah.
I'd go to the country club or the golf course, and I'd practice it and get that trick down. And then trampolines came out. So in the summer months, what I did is I would just bounce on a trampoline all summer and learn tricks.
And basically do the tricks on trampolines, if you will.
That's exactly how it happened.
Go back to when you were 16 for a second, though. So you had this job that you got as a young kid, first quote-unquote real job, you said, at the restaurant, and then you ended up starting your own clothing line called Fat, P-H-A-T?
Correct.
Fat clothing line. What happened there? What did you do with it? You started at your basement at your parents' house? Who were you selling to?
Yeah, so kids in school.
I
started with a dozen T-shirts that I printed with my art teacher after school.
Okay.
Yeah, Mr. Mahalski was his name. I'll never forget that man.
You were selling T-shirts?
Yeah, just started with a dozen shirts. I sold a dozen. I had enough money to go do 2 dozen, and then I did 2 dozen in hats, and it literally just one progression after another. But then when I was going to snowboard contests, I would take my clothing line, and I had developed a catalog, and because I'd kind of learned a couple things, and I would then either do consignment or I would sell it to these different shop owners. Which is what got me the idea and the dream of having my own shop. As all these shop owners, I'd sell my clothes to them, and I'd be like, these guys have the life.
Because they have the shop.
Got their shop. They're going snowboarding. Like, they're just living the lifestyle I wanted. So that was that
Did you ever get a shop out of your clothing line?
17 years old, I started, yeah.
Really?
Yeah, that's kind of, the clothing line started, and by I was 17, I had 3 seamstresses working under me. I had, I don't know, it wasn't huge, but I had clothes all over the place, and that's when Fat Man, the idea of the shop came up. And
did you, so when you say shop, you're talking like a strip mall or inside of a mall itself? Where was the shop at?
The first shop was in the Lockport Mall, believe it or not.
So you went like to a big mall?
Well, a little mall.
Yeah, sure, but you go to a mall and got a store inside of a mall at 17. I'm assuming you probably had to have like your mom or dad sign the lease or something for you?
That's an interesting story. So I remember I got the idea, and I knew I did the numbers, and it was going to take 70 grand. Now remember, I didn't have any money back then. I think at that time I had an Audi 4000, kind of just a beat up car. I had a baseball card collection, and I might have had a dirt bike. And that was my collateral. And I started getting, like, I designed a business plan, I read a book on how to do it, and I went around to all the banks and all the people I knew that had money, and I heard no from everybody, including my father, who told me, no, go get a job at the factory, I'll get you a job. And that was kind of an interesting, pivotal time in my life, because I stopped talking to my dad for 2 years because of some things. But what ended up happening is I almost gave up on that dream. And my mom watched this. Now, my mom never lived her dream. She never really, went on to do what she wanted, and she was watching her son, her punk skateboard, snowboard son, almost give his dream up. And she had gotten one thing out of the divorce, and that was the house.
So they were divorced at the time.
Correct.
And all this went down. She got the house through the divorce.
Yeah.
Were you living with her at this time?
I was, yeah.
Gotcha.
My mom raised me.
Okay.
Yeah.
So what'd she do?
She put her house up on the line so that her crazy 17-year-old kid could chase his dream.
Your mom, through the divorce, got the house through the divorce, had, I guess, some equity or something inside of it?
Exactly, $75,000 at that time.
And put the whole house up as collateral to get you a shop for Fat Man clothing line in the local mall there.
That's correct. It was. I look back at that, and when I did it, I was like, oh my gosh, yes. But looking back, that was a really stupid thing.
Well, I love that, dude, because like so many parents today are so hyper focused on go to college, go do this, stay in this line, if you will. And it's very rare you find parents that like promote and push creativity, entrepreneurship, etc. And look what it turned out for you. My parents were the same way. Look what it turned out for you, man. It's what would have happened if you wouldn't have done that? Where would you be now if you wouldn't have done that?
Working at the factory my dad was working at and retired from, and pension got cut, and the rest of the story.
The whole story of pension.
My mom And someday it'll be a book. My mom is my unconditional one.
Wow.
She is the one person in my life that has always believed in me through everything I've done. When everybody else has said, you're crazy, why would you do that? That's a stupid idea.
Yeah.
She's always been that one person that said, do what your heart tells you to do.
Philosophy here, do you think successful entrepreneurs need at least that one person? Or do you think entrepreneurs can go on their own and with nobody believing in them?
If you're asking me, I think absolutely. You have to have that one person.
Yeah.
Now, that it might not be your mom. It might not be your family. It has to be that one person that believes in you when no one else does.
Yeah, because, you know, in entrepreneurship, man, it's dark days and ups and downs and all that stuff. And it is nice to have that rock, if you will. Yeah, I probably agree with you on that one. You got to have that one person that agrees with you there. Yeah, you and your mom still together?
Oh, my mom is,
still your rock after all these
rock.
years?
You know, can I tell a little story about my mom?
Man, of course.
My mom, so her whole life, like when I was being brought up, she had a daycare in the house because she didn't want to work outside. And throughout her whole life, she's always just been self-employed, but just little things, you know, cleaning houses. She's in her 60s now, her knees hurt, her body's killing her. Yeah. So now, one of my dreams, and I do a vision board every year, has been to retire my mom. Yeah. So I finally retired my mom. Now she's still cleaning some houses. I can't get that out of her, but I set it up. I got a bill pay where she gets a check every single month. Right. And I taught my mom some things about money and how to have her house pay for her car payment.
Yeah, I was going to ask you, did you ever get your mom's house back paid off or pay the loan back or now bought her a house or whatever? Was there a payback, if you will, that you did for her?
Wow, that's a great question. My mom's house will never be paid off because that would mean her money is sitting lazy, not working for her. My mom's house, that home equity line of credit is always being lent out on real estate deals or in my deals, and she's getting a check every single month that literally pays for her car payment.
And that's an interesting point because you know, most people want their house paid off. They want to own the house free and clear, and you just said the opposite of that. You just said your mom's house will never be paid off. I think probably most people are thinking you were going to say, oh yeah, I pay my mom's house off. You said the opposite.
Absolutely.
Go a little bit deeper into why you said, what's your philosophy on why never pay it off?
So I love when people, you know, get excited, they pay their house off, right? And they throw a party, right? You ever seen one of those, like, my house paid off parties?
They burn the note and I've seen that before.
You know, it's all this big thing. Like, I always have dreamed of going to one of those parties, you know, and I'm just going to go for the beverages. But you go to one of these parties and I want to go up to the person, I want to say a couple of things. I want to say, congratulations on paying your house off. Can I ask you a question? What changed in your life? And the answer is always going to be, well, I don't have a house payment. No, no, no. Are you able to take more vacations? Are you able to do more things? Are you able to, you know, pay for your kids' college? Yeah. Because the answer will be no. And if they said yes, they'd be kidding themselves because their money is sitting lazy, doing absolutely nothing. And the visual behind that is when people pay their house off or they got equity sitting lazy in their house, their money is literally sitting on their couch, eating their potato chips, drinking their soda, watching their TV, when that person's off hustling at work, working harder, working longer, trying to make more money to have a better life. Because I just think people have always been taught that that's the dream, but really, isn't the dream to have your money work for you so you don't have to work as hard? But that's not what we're taught.
Yeah, it's not what we're taught at all. And you know, just diving this with you here, probably a little bit ahead of schedule here, but just thinking through this with you, it's like everything you're saying, if you think about this, is like going against, let's say, Dave Ramsey. Like you're almost like saying the exact opposite. And you know, for a lot of people, he's like a financial god to a lot of people, but you're really saying the exact opposite of what Dave Ramsey's saying.
I have a lot of respect for Dave because he gets people to take action on things that they normally wouldn't. Yeah. But I think he's missing a huge piece.
Really?
He really is. He's missing a massive piece that would change people's lives. Yeah. Getting out of debt isn't going to change your life. It's going to help your life, but it's not going to change your life. Making your money work for you will change your life.
What would you say you think he's missing a big piece? What would be that piece he's missing there?
Well, I mean, what do you do when all your debt's paid off? What do most people do when they get all their debt paid off? Most people go rack their debt back up.
Yeah, that's true.
Right?
Yeah,
that's what they do. Or they just keep doing what they're doing. They keep, you know, living the life they are. They don't really achieve the life that they want. But that's really difficult to do if you don't learn how to make money work for you.
Interesting. Have you ever had a conversation with Dave?
I haven't. That day will
come. That'd be a good conversation to have there. On that note, man, let's take a step back here. Tell us a little bit, sort of a 2-minute elevator pitch, if you will. Yeah. What is it your company does? Where's Chris Naugle at now? We went through kind of your childhood there, but where are you at now? What do you do now?
So, well, we have a lot of different companies, but Money School is our main company, and what we do is we teach people how money really works, the secrets behind money and the things that nobody will ever teach you. So I had a history as a financial advisor for a long time, Wall Street and all that good fun stuff, but I retired in 2018 when me and my wife got a show on HGTV. My broker said, you're either going to be on TV or you're going to be a financial advisor. I said goodbye. I sold my practice to a guy in my firm, and that's what we did. But the company I created out of that, because if I stayed an advisor, this never would have happened.
Really?
So the company is now teaching people everything that I didn't learn as an advisor. All the things I wouldn't talk to people about as an advisor because they couldn't pay me. Right? So as an advisor, we were taught to sell. We're taught to go out, sell stocks, bonds, mutual funds, all these things. And I'm not saying there's anything wrong with that, but it leaves so much out. It leaves out what wealthy do with money, because nobody wants to teach somebody how money works when they can't get paid for it.
Right.
So that's the void. And that's what our company does. We teach people the secrets behind how money really works and how to use money in very unique ways for anything that you're doing in your life.
So let's go back to that, because I just learning about you, you said you were actually, at one point, were a financial advisor?
16 years of my life.
Really? So what age bracket was that right there?
23 until 2018. So what would I have been? 30, I forget how old I am. 39, 38.
So for 16 years, from 20s to mid 30s, like whatever you call it, you were actually a financial advisor.
Correct.
When you say financial advisor, are you talking someone that like on Wall Street, or are you saying someone that would give quote unquote financial advice to ABC person that came in your office or whatever? Is that what it more?
So it evolved. It started doing ABC advice to people. It started in life insurance. Then from there it evolved into being a registered rep, which is just registered securities. And then from there I got my stockbroker license very soon after. And then I was managing portfolios for a firm. We had a small RIA. So we were managing large portfolios and then using those portfolios to help people's retirements. We were doing some pension plans, and and my job was I did a lot of the management of the portfolio, the day-to-day operational. I had a small client base that I managed money for, and I really was the guy that was looking at the patterns in the market to understand what are we going to do, what are the next things that are going to happen in the markets that we need to be thinking about today. So at the end of my career, that's primarily what I did.
Are you, to follow up on that question there earlier, are you saying that in those 16 years as you were a financial advisor, you're kind of giving different advice now with money that you do now than what you were back then, or is it kind of the same thread, if you will?
Well, I'm not going to say it's the same thread. It's 100% different than what I did as an advisor.
Really?
But it's all using the same vehicles we used in a completely different light.
I can't wait to hear about this.
So I do not talk to people about stocks, bonds, mutual funds anymore. I mean, I discuss the markets, but I don't go into that stuff at all. I actually don't even want to talk about it. I think if that's what someone's doing with all their money, I think they're missing the biggest piece of what they should be doing.
Interesting, man. So the name of your company is?
Money School.
Money School. And what's the website if they want to go to it?
So chrisnaugle.com is the best website to go to, and then that gets them to any of my other companies.
Any other companies. And the Money School in general is education about money philosophy is what you're going through right now?
It's just education on how money really works, and in lots of different realms. It works for entrepreneurs,
yeah,
real estate investors. I mean, there's lots of categories and lots of subsections that we have within the company, but yeah, that's what we do.
So right now, just before you get too deep, you go to chrisnaugle.com, and that'll take you to the different place that you want to go to through there. But on Chris Naugle, again, you're not going to be a financial advisor, if you will, the old school financial advisor that you were for 16 years.
No way.
Okay, so I'm going to go deeper into that for just a second here. You use the word a lot. And when I looked you up online, looked at your Facebook and so forth, I hear this buzzword that you use a lot called infinite banking.
Yes.
Right. So I see that word that you're floating around on different things there. What is the word? What does that mean? Infinite banking. What does it mean to you?
What does it mean to me? It's infinite in what you can do with banking concepts. Okay. Essentially, that's what it means to me. And the thing I like about it is banking. If there's one thing that people could learn how to do, they should learn how banking works. Okay. They understand the fundamentals of how banks make money. And it's not what they think. A lot of people, I ask them this all the time, what does a bank do? And they tell me what they think a bank does, but they're missing the key underlying thing that a bank does. And a bank moves your money. It's all a bank does. Actually, I start with a question I ask people. I say, what business in the world uses compound interest? And everybody, you know what everybody tells me?
What?
Banks.
Okay.
And then some people say Wall Street, but they say banks. And I say, no, banks charge you compound interest. they pay you compound interest. They do not use compound interest because banks are in the business of moving money. Think about it. You go into the bank and you make a deposit at your local bank, and you give the teller your bill. Now let's just say you wrote your name really big on it and you highlighted your name and you handed it off to the teller. Does the teller take your dollar, put it in a little box in the back with your name on it, so that when you come back a week or a month later, you get your dollar bill back? Absolutely not.
Yeah, I know.
The little cubicles behind you when you're making your deposit, they are lending your money out. And in this process of them taking deposits and then paying you, well, I hate to say next to nothing, but they take that money and they move that money out in the form of loans in different things, but mostly loans, and they make 400 to 1,300% on your money doing this. They clearly make 500% more than you do on your money, and that's being generous.
So when you say they're moving money, like you hear this terminology a lot of it's almost like, I don't want to say the word conspiracy theory stuff, but it's almost like you hear people talking about the bank is actually taking your money and lending it out to other people. Is that what you're saying? They're literally taking your money and lending it out to other people?
That's exactly what they do. They actually lend it right back to us. Like I give the bank money, and then I go to the bank, because this is what I've been taught to do my entire life. I go back to the bank and I take a loan from the bank, and the bank gives me my money and your money and everybody else's money right back. And then they charge me an interest rate on that, and that's just the system and how it works.
And part of what you're talking about is where someone is becoming their own bank?
Correct.
In theory?
You can mimic exactly what a bank does, but you can do it even better than a bank does because it's your money. You're not using someone else's money, so you don't have rules for your own money. So infinite banking allows you to take your money, move your money in a manner just like the bank does, and another thing too that infinite banking does is, what is a big problem in America? Debt. Credit card debt specifically.
I was going to say socialism, but okay.
Well, we're not even going to go there.
Go ahead.
But,
keep going.
Credit card debt. And think about what we do. Every dollar we make, it's statistically, we give up 90 cents of every single dollar to other people. So if we wanted to build wealth, everybody, to build wealth, they think, I got to go out and I got to work harder. I got to work longer. I got to get lucky and have this thing do, work right. I got to buy this stock and have it, go to the moon. But really, building wealth is way easier. What if we just had a method where we had a banking system that we created, where we had the method to take money and pay off a credit card, but then when we pay the credit card off, how much were we paying that credit card in interest?
Just whatever, say 20% interest.
Yeah, 20% is a good number. So you're paying the credit card 20%. What if we paid that credit card off and we took that, let's say it's $100 a month we're giving Visa, and we paid ourselves back that $100. How much of a return did we just make by doing that? 20%. But what if your money that you use to pay off Visa never stopped earning interest? What if that money continuously earned interest even when you took the money out to pay off Visa? That's pretty incredible, and that's what infinite banking does. It is literally, it's a 200-year-old strategy. It's been used by the wealthiest individuals that we all know about, the Rockefellers, the Rothschilds, the JPs. They've all used this. Walt Disney started Walt Disney World with it. J.C. Penney and Sears. I know, bad examples in today's world, but they were both founded and formed
with what you're talking about, infinite banking concepts here?
Yep, it was considered like privatized banking. That's another term.
So this isn't a concept you created or anything like that? No. So this has been around for hundreds of years now?
Hundreds of years.
And you're saying that the wealthiest families in America are using this infinite banking concept you're talking about here?
Well, that's interesting. We didn't go through my whole story, but I've lost it all twice. I lost it all in 2008, and maybe we'll get there, maybe we won't. But my story, you can get it online.
Sure.
And the 2014, I lost it all again. But in 2014, as an advisor, I was still snowboarding, and I had my shops. I had found this concept called infinite banking. Somebody who was lending me money told me about this thing, and I remember that conversation. It was actually right here in Utah. I was at a cheesecake factory with my lender, and he starts telling me about this thing. And I'm listening to him, and I'm like, Mike, what are you talking about? What you're talking about is a vehicle that doesn't do what you just said it does.
Right.
And that's kind of where it all started. And I had an epiphany in that moment. I started questioning everything I'd been taught my whole life about money, right then and there. And I learned what the wealthy were doing with money and why they just kept making more and more and more money. And it is this thing called infinite banking. It truly is the foundation that they use to move money.
You talked a lot about that it's based off of insurance.
Yes, it is.
How does the insurance play into it?
Whole life insurance, that boring whole life insurance that Dave Ramsey
says
is the worst investment
he's
you can ever put money
in. That it's a
sure.
horrible
Him
concept.
and Susie Orman, they love whole life insurance.
Yeah, so you're going to get some two big hitters there.
Yeah, but
both of them say that like whole life is like almost like a death wish, a hole of money basically.
Yeah, they say it's the worst investment that there is, and you know what? They're right. Whole life is not an investment. It is a guaranteed instrument. Your money cannot fluctuate. So an investment involves risk.
Yeah.
Whole life insurance involves zero risk. But most people, when they think of whole life, what do they think of? Money that goes to somebody else when I graduate.
When I die.
Graduate's a nice way of saying.
Graduate's a great word. I'll use die. Yeah.
But when they graduate, money gets paid to their beneficiaries. Sure. That's what everybody thinks. So why would you ever want to put money into something like that? Because Dave and Susie say it's a terrible place to put money. It's because they're not using it the way we do. Infinite banking doesn't use whole life any way that regular life insurance is used. Infinite banking uses whole life as a machine just to move your money. Remember how I said the bank moves money?
Right.
All the whole life policy is, and it's not a normal whole life off the shelf. That's the biggest misconception.
Okay.
It's specially designed, completely engineered for banking, and it's literally the complete opposite of a regular whole life. You put money in this machine called the whole life policy, and all you do is you put it in there and you immediately take it back out. And let's say we use it to pay off Visa. And then that $100 we were given to Visa that was 20% we used to pay them, now we pay that back to this whole life policy. Essentially, now we're making a 20% return on that money we recaptured from Visa. Okay? But how much money are we making on that whole life? That whole life is contractually guaranteed to pay you 4%.
The whole life is.
Yeah, but that doesn't get anyone excited, all right? Well, maybe right now it does, but 4% shouldn't get anyone really excited.
Well, 4% is more than you're making most of the time from a savings account and stuff like that. You're not normally making 4%, right?
Right. And the companies we use are mutually owned companies. So not only do you get the 4% guarantee, you're also going to get a dividend every single year because they return the surplus to the policy holders. It's like stockholders, right?
Okay.
In a dividend paying company. But a mutually owned insurance company, they return the surplus to the policyholders.
Okay.
So now instead of just making 4%, you're also making a dividend. And that can be as high as 2.2%. And that's what they are right now with some of the companies. So you're making 6.2%. Today.
For example, you'd be making 6.2% on your money while it sits in this insurance policy that you guys are talking about. But worst case, you're saying you're going to be making 4%.
Yeah, if you never got a dividend, which would be unusual because they've paid dividends hundreds of years. But if you only made the 4%, that's still better than anything you're getting out there on a guaranteed basis.
Okay.
You're not getting into your savings account. No CDs are paying that. Your checking account's clearly not giving you that. And remember, all you're going to do is you're going to put your money in that, and you're going to move that money back out.
Yeah, so that's the thing. You're not putting it in there and like leaving it there like a mutual fund would be leaving it, right? No. You're putting it there, but then immediately withdrawing it or moving it back out?
Immediately in the first 30 days is what we teach. Is basically you put the money there, we immediately move it back out. But we have to have a place for it to go. Okay. So we start with the simple thing like debts. We want to pay debts off. So we'll use a snowball approach, which Dave Ramsey uses.
Yeah.
We'll snowball their debts. But now what we've got is a vehicle that is continuously paying us uninterrupted compound interest. Now, a lot of people don't understand uninterrupted compound interest, but Albert Einstein did. And Albert Einstein called it the 8th wonder of the world.
Yeah.
He said it's the most powerful thing in the financial world if you understand it. And the only way to really kind of help people understand it is there's an I think it's old, an example. Would you take $1 million right now if I gave it to you, or 1 penny doubled every day for 30 days? What would you take?
Well, I'm assuming it's a trick question, so I'm going to assume the penny, but I think most people would always say the $1 million today.
Most people say the $1 million if they've never heard it. They're like, why would I want a penny doubled? I'll take the $1 million and I'll go make $2 million on it. Great, go do that. But what they missed is they missed the uninterrupted compound interest. You see, that penny doubled every day for 30 days turns into about $5.3 million in change.
Really, in 30 days?
In 30 days. But it doesn't really start turning more than the million until, correct me if I'm wrong, but it's the last few days of that 30-day cycle. But that is the definition of why infinite banking and uninterrupted compound interest works. But we sort of missed that. We kind of skipped past that. So remember, we're depositing money. We're changing one thing. That's all we're doing.
Right.
Let me take a step back, too, because our whole lives, what have we been taught to do with money?
Save it.
Save it. But
hold it.
In saving, haven't we been taught to give up control of our good dollars today?
Right.
Literally, like if you've got $1 today, your dollar is worth the most today than it will ever be worth. And if people don't believe me, then go back 20 years ago. How many candy bars could you have bought for $1?
Yeah.
More than today. But what we've been taught is to take those dollars and give them away, okay? Give up control of them. How do we do that? Well, we deposit it in bank accounts. And what does the bank do? They move that money. Now, a lot of people would say, yeah, but my bank account, I'm in control of that. My thing I would say to them is, you haven't learned anything from the past. Go to your bank right now, if you got more than 10 grand, and try to take all your money out in one swoop. Just go to the bank and say, you know, Mr. and Mrs. Teller, I would like to take all the money out of the bank right now. And the teller will pull it up with the big smile, and they'll look, and all of a sudden they'll see that you've got a little bit of money in your bank account. Ooh, Mr. Naugle, we can't give you all your money today. We can give you $3,000 or $5,000 today, and you can come back tomorrow. And I'm going to look at the teller and I'm say, no, 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 I want my money now.
Right.
Like, that's my money. I just let you use it. I want it back now. But they can't. And there's a whole thing that I do where, you know, the VP comes over and does this whole thing, but you are not in control of your money if you can't just go take it all. So we've been taught to give up control with bank accounts, but also where's the biggest majority of money sit today? Employer-sponsored retirement plans.
Yeah.
We have literally been taught, and I was too as a young age. My grandmother said to me, she said, don't ever be like Grandpa and I. Make sure when you get a job and there's a 401k, you put as much money as you can into it. Because that's what they were taught to do.
Right.
But what are we doing when we do that? We are giving up our good dollars today to somebody else to be paid back with weaker dollars later. Because a 401k, if you put money into it today, without penalties, you can't take it out until 59 and a half. So your money sat in someone else's control that entire time. Now, sure, it grew in the market, whatever you're doing that, and hopefully it went up and up and up. But also, what happened over that period of time? You make more money, and your taxes went up. Because even if you don't make more money, taxes always go up. And even if they don't go up, they just find more stuff to tax us on. So when we take that money out, we're, number one, taking weaker dollars back because of inflation. Number two, we're getting taxed on that money. And number three, we literally did not have control of that money the entire time it sat there. But it's really funny. We have been taught to do things with money we would never do with things that money buys. Would you ever go to the grocery store, buy a nice Italian loaf of bread, come home, put it in the freezer, close the door, wait 5, 10, or 15 years, then come back, open the freezer, take out that freezer-burned loaf of bread, and look at it and say, yum. Yeah. You would not eat that. But you wouldn't buy a car and wait 5, 10, or 15 years to drive the car either. Right. And you certainly wouldn't buy your dream house and then just wait 5, 10, or 15 years to move into your house. But that's what we do with money.
And you're saying that's what people are doing with money when they put in the 401ks or retirement plans. They set it there and let it sit there for 10, 15, 20 years before they take it out of the fridge, in your example.
Right. We've been taught to park our money and let other people be in control of our money.
And you're saying on the infinite banking side, with your philosophy, you put the money in the infinite banking insurance, and you're telling people to take it out in the first 30 days, take that money back out.
Yep.
And go invest it into whatever it is.
Yeah, pay off credit card debts. Maybe buy cars. Like
but can you take that money out and can you buy a you know, whatever it is, say you want to buy a real estate investment. Can you take the money out and buy a real estate investment?
100%. I built my rental portfolio with this system. And sure, I didn't use my infinite banking in the beginning to buy the entire properties, but what I would do is I would go to the bank would give me 80%. Okay. Then I would take my infinite banking, I'd take a loan from the insurance company, because we didn't talk how that movement works.
Yeah,
we'll get there. But we take a loan from the insurance company, which is just collateralized by our money that's sitting in that account. And I use that loan to then fund that 20% gap in the rehab. Then what I do is I charge my company 6%. So, because that money's mine. This is my bank, right? That whole life, that's mine.
That's your money on this side with the insurance policy.
I loan that money to my LLC. My LLC then pays me back at a rate of 6%. But where does the 6% come from? The rent that property generates. So you can use this for real estate. You can use this to buy cars. Actually, if you use it for cars, there's a method that will show you how to get all the money back for every single car you'll ever buy, drive, and own. And it's really easy to see. So
help me back understand this a little bit, especially for the viewers. So you had this money, this insurance account. You pulled out, I'm going to make up a number here, $20,000 for the down payment of this, let's just say, single-family rental property. When you pull the $20,000 out and use that for the down payment, I get it. You're charging your company you're charging 6% in your example of interest back to for the $20,000. So now you're making 6% on your money here. But are you saying that your money here is still making the guaranteed 4%?
Exactly. So when you make a deposit into these specially designed whole lives, this infinite banking concept, your money instantly starts earning 4% plus a dividend. But when you take that money back out, you're not actually withdrawing it. You're taking a loan from the insurance company. Insurance companies have so much money, and they just want to move their money the same way banks do. So insurance companies will loan you money from their general account. There was no questions, no credit apps. Like, click a button and the money's in your account.
But you got to have the money in your account.
Precisely.
Okay.
You got to have the money in your account, which is why you got to change that one thing, and that's pay yourself first. You got to stop giving up control and start giving yourself the control. Put money into this account. So when you take the money, you're using the insurance company's money as a loan, and the insurance company does charge you interest, but your money's earning 4%. Okay. And a dividend, so it's compounding. So this year you make 4% on whatever's in there. Then the next year you're making money 4% on whatever that increased value is, and it keeps going. That's that penny doubled every day. But this loan you took from the insurance company, right. First off, people when they think of a loan, they think, oh my gosh, I don't want to get deeper in debt, and now I got to pay this loan back. Right. Great, don't ever pay the loan back. When you're the bank, you control the terms.
Don't ever pay the loan back. So let's say you borrow 20 grand from your insurance. So the 20 grand, if I understand it right, in theory, is still sitting in the insurance account because it was a loan, which means that 20 grand is still making you this 4% plus dividends if they pay out. And then you borrow the $20,000 to put as a down payment, and you're saying don't pay it back now?
Well, I pay mine back. But let's just say somebody was like, I don't want to pay that money back. Great. Okay. Don't.
You don't have to pay it back?
The insurance company will never ask for that money back. They won't care if you ever pay it back. Matter of fact, they'll never send you a statement showing you that, hey, pay this back. Okay. So that probably confuses the listeners.
Yeah, you don't have like a monthly payment?
Wait a second. Well, no, you don't. But you could set one up like I do. You could recapture that money.
You could pay it back if you wanted to,
yeah,
but you don't have to.
No, because remember what else did that insurance company promise to do with that contract?
Give you a death benefit?
Yeah. Someday when you graduate, that insurance company has promised to pay a death benefit to your beneficiaries. Okay. So when you take loans from the insurance company doesn't care if you pay them back, because someday when they pay that death benefit, they're just going to take your loans away from the death benefit. You're literally just leveraging your death benefit by taking loans.
But what if you stop paying the insurance? Like, what I think of insurance, I think you got to pay a whole life, like a premium every month. What if you just stop paying the whole life policy?
Well, that's interesting. So when we set these up, we set them up with a 10-year funding. So instead of a premium, people think of premiums, they think of a bill. When you're doing this, we're creating a banking system. That's why it's called infinite banking. We're creating a banking system, so you're making deposits. Does it feel good when you go to your bank and you make a deposit into your bank?
Yeah, sure.
Yeah, I love it, right? You're like, yes, I got more money than I did the day before. Well, when you pay your car insurance bill, does that feel good?
No.
No,
yeah,
right? Because you're paying a bill. So why would we want to pay premiums? We wouldn't. Okay. So what we're doing, we're actually making premium deposits. We're actually making deposits into this system. Because if they're going to pay us 4% plus a dividend, and that money's going to build and build and build, and we can use that money anytime we want by taking loans from the insurance company, like, you're not making premiums, you're making deposits. Right. And when we build them for a set premium schedule, whatever the client wants. Yeah. Could be 10 years, could be 20 years. I can tell you, I'll never build one of mine that ever stops allowing me to make deposits. Because when I make a deposit in this vehicle that's been compounding this whole time, my deposit, I can make I'll just give an example. I got a plan that I make $10,000 deposits to per year. Okay. In the 10th year, if I make a $10,000 deposit, 30 days later, I can go to that insurance policy and I can take $10,300 out. 10,000, or I'm sorry, 13,000, not 10,300, 13,000. So I deposit 10. Okay. 30 days later, I take 13,000 out. Okay. What kind of return is that on your money?
300 or
30%. 30% return. Why would I ever want to stop making deposits into that account if I'm going to get that kind of a return? And that every year will go up and up and up. Remember the penny doubled? Right. Same concept. How I explain this to people is I say, imagine in your garage you've got a vending machine. And every day you go out to your vending machine, you put a dollar bill in your vending machine. And your vending machine then gives you the dollar bill back. You're like, that was pretty cool. Right. But then all of a sudden you hear the cup drop and you get your coffee. And you're like, wait, I got my dollar back, I got my coffee. But then the change drawer, you hear cha-ching, cha-ching. Right. You're like, wait a second. I got my dollar back, I got my coffee, and now I got some change. What would you do? You'd put another dollar in the machine, right? So the next day you go back and you do the same thing. The next day, you put the dollar in, it gives you your dollar back. You get your coffee back and you're like, this is great. But then you hear cha-chink, cha-chink, cha-chink. So every single day, your vending machine will give you more change back because of uninterrupted compound interest. Mm-hmm. But you still got your coffee, which is the ability for you to use your money, and you got your dollar back, which is your original deposit. There is no way the system will ever not pay you more money the next day, because that's how uninterrupted compound interest works.
If, let's say, it's as sexy as you're describing it right now, and the Rockefellers and J.P. Morgan and Walt Disney use this concept, why aren't more people using it? Why isn't this a more talked about? Why is it so like mysterious then?
I wouldn't say it's mysterious. There's just not a lot of people that understand how this works. So I was an advisor for 16 years. Do you think once any of those companies, including the big insurance company I started my career at, taught me this? Not one of them did. But why wouldn't they? If it's so good, why wouldn't they want? Because in order to do this, in order for the person that's writing this specially designed whole life to do this the right way, they have to give up 60 to 90% of their commission. So do you think an advisor or someone like what I was wants to give up 60 to 90% of my commission? No way. People don't want to make less money, they want to make more. So to do this, somebody has to be willing to give and give up a lot. So then people say, well, why would you do it? Well, because it's the only way it works, that's why. Because the banks have been using this for hundreds of years. Matter of fact, banks are the #1 purchasers of whole life insurance in the world. And just look at, take Bank of America. Look up their financial statement. They own more whole life than they do all the land and all the buildings combined.
If they're investing in the insurance companies, if you will.
Yeah, because they understand this concept that we just explained about moving money, because that's what banks do. And banks are now looking at it saying, wait, we can get uninterrupted compound interest, still use this money, and remember there's a death benefit, right?
Yeah.
So how does a bank use it? Vice presidents. How many VPs do you see at a bank when you walk in? VP of janitorial, VP of sales. There's a VP of everything, and nobody ever really wonders, why is there so many vice presidents? Well, the bank needs an insured body to buy this whole life, right? Well, the bank can't just buy insurance on just anyone. They have to have an insurable interest. So a VP is considered an executive of a bank. Therefore, when they become an executive, the VP or the bank has an insurable interest. So what the bank does, and don't quote me on this, but the bank basically says, Mr. VP, we're going to give you a raise. If you stay with us for 20 years with these minimal pay raises we're going to give you every year, at the end of your career with us, we're going to pay you a deferred compensation, which means every month you're going to get a check on us for the rest of your life until the day you graduate. The other thing we're going to do because of your promotion is we're going to give you a fully paid up life insurance policy for your family. We're going to give you a $100,000 fully paid up plan so that someday, if anything ever happens to you, your family will receive $100,000. Thank you for working for XYZ Bank.
Okay.
That's what the VP gets. What does the insurance company get? The insurance company gets the ability to then go buy a nice, healthy, specially designed whole life policy. They call it BOLI, bank-owned life insurance. So that's the
terminology for it?
That's what you look up.
BOLI?
BOLI.
Okay.
So they buy this whole life, and they put a ton of money into this. That employee goes on and does their thing. The bank uses this money the whole time. Someday that employee retires. They start paying a payment out every month out of this specially designed whole life. Then that employee, someday, what's going to happen to all of us? Well, we're going to pay taxes, and someday we're all going to graduates. That insurance policy pays out $100,000 to that employee's family, and they're very thankful for that. But who else receives a big, fat death benefit?
You're saying the bank is getting a death benefit check off of their, in your example, vice presidents that they're giving this insurance policy to?
Right.
Really?
So that insurance company then pays a big death benefit to that bank, making them whole for every penny they've ever put in, and probably significantly more.
I know it sounds weird, but all that's legal?
It's been being done forever. Now, there's a company, I don't know if I should use it, but Walmart, that did this illegally, and they were buying life insurance policies, whole lives, on every single employee.
Really?
Well, they were, and it's public, so I can probably say this, you can look it up, and Walmart got sued huge for this because there was no equitable interest for that employee. So the employee would basically get, a job at Walmart, an executive position. The company would buy a paid-up life insurance policy on them, a whole life, and then that employee would die, and Walmart was getting a check, but that family got nothing.
Right.
Yeah, it's public. You can look it up.
Is this a concept of, you hear the concept of the rich get richer and the poor get poorer?
Correct.
It sounds like Bank of America, in your example, Walmart example, were making a ton of money off of the death benefits of their, now, were they using whole life or more of the infinite banking side of it?
They were using the same thing as the infinite banking, but it's just a specially designed whole life.
Interesting. Can you buy that policy you're talking about? I'm going to come back to it in a second, but can you buy the policy you're referring to from a regular life insurance salesperson?
You could if they understood how to build it, because it's built completely upside down. You can't walk into the insurance store and just buy a whole life off the shelf. It will not do what we're talking about. Because a regular whole life, if you make a deposit or a premium into it, you can't take that money out immediately in the first 30 days. Heck, usually there's no cash value for the first 3 years.
Yeah.
But the plan I'm talking about has money immediately in the first 30 days.
Yeah, so if I'm listening to you, just painting a picture with you, I think the benefit that I'm hearing is that you put this money in, make up a number, $10,000 or $20,000, let's say. You're making a minimum of 4% on it. You're going to borrow it back out immediately in the next 30 days, whatever it is that you're talking about. And then that 20 grand you're buying a house with, a down payment for a house. and now you're making interest off of that $20,000 while the $20,000 is still sitting in both places.
You're making money.
It's sitting in the house, and it's sitting in insurance, and you're making money on both of those at the exact same time, even though you're basically taking like 20 grand and splitting it, doubling it, and making money off both of them.
Right, because in the whole life, the infinite banking policy, you're making interest, 4%.
Right.
Then you're taking a loan from the insurance company at a lower interest rate than what you're making, plus it's simple interest they're charging you.
Right.
But then you're taking that money and you're buying a piece of real estate, or you're paying down debt, or you're buying a car.
Right.
But then whatever you're doing with it, you recapture that money back into your policy.
Yeah.
So the biggest mistake people make with this concept is they'll take the money out, they'll pay off a credit card, and then they'll just be like, okay, I'm done. You know, and they won't do anything.
Right.
No, you have to take the money you were giving to Visa and pay that back to yourself.
Yeah, I mean, obviously, anytime you can make, anytime you can make double interest, if you will, double payments on your own money, is how you're going to grow into more wealth through the concept. Let's pause on this topic just for a second. I want to do a quick sort of rapid fire question here. I'm going to change it up with you for a second. I'm going to go back into what you were talking about, but I want to go into a little bit off-topic, rapid fire. You're going to give me the first answer that comes to your head as we go through here, and we'll see where this thing goes. So I got about 8 or 9 of these, and then we'll circle back around at the end of it here. But really quick, the first thing that comes to your head: would Chris Naugle choose snowboard or skateboarding?
Snowboarding.
Over skateboarding. X Games or Winter Olympics?
X Games.
Apartments or single family?
Single family.
Tony Hawk or Shaun White?
Tough one. Probably Tony Hawk.
Tony Hawk. Reality TV or podcast host?
Podcast host.
Really? You did both. Crypto mining or day trading?
Day trading.
Corporate job or entrepreneur?
Entrepreneur.
Capitalism or socialism?
Capitalism.
Investing in red states or blue states?
I don't know if it would really matter, but probably blue.
Blue. And living in blue states or red states?
Boy, right now, it doesn't even matter.
All right, so let's go back on some of these. I want to hit some of these with you, right? Why don't you choose Tony Hawk over Shaun?
Yeah, that's an interesting one, and I love both of their stories. That was the most difficult question. Tony Hawk was somebody that followed his dream and pushed harder than anybody. Yeah. And what I like about what Tony's done is he is still doing it. And he is still doing it, and he, not for the money. He's doing it for the pure love. Now, Shaun White is doing the same thing, but Shaun White meant more, he went very mainstream, very, the money. Where Tony made a lot of money, but he is so true to his dream and his vision that I have more respect for that man than
because you chose snowboarding, but then not Shaun White.
And that was a hard one. I almost said Shaun White, because I know Shaun.
Yeah.
I almost said Shaun White, but then I thought about it, and I'm like, Tony is just more of an icon, in my opinion, that he I think, can help more people with his story than Shaun.
Last one I talked to you about, you said podcast over reality TV, because you did reality TV on, I think, HGTV. And what was the name of your show that you did?
Risky Builders.
Risky Builders. And so you have done reality TV and podcast hosting, and
Correct.
you chose podcast hosting.
I did.
Over any of them. Why is that over reality TV?
More value for the audience, and it's more authentic.
Yeah. So you chose, but you got a big following off of the reality TV side.
I did.
Wouldn't that allow you to then leverage that for the entertainment or the educational side?
Exactly what we did. Yeah, the TV show was a dream, and it was a 4-year-long journey to get that show. It wasn't just we sent a video into HD. Matter of fact, we got turned down the first round because I wanted to do a reality show where it was flipping houses, and then you take a little bit of skateboard, snowboard, and mixed it. So that was our original concept. They said no, but then we ended up getting it. But it took 4 years. The problem with that is it's not scripted to the level that some people think, but it's certainly, there's a lot left out. And I think it leads people to a false conclusion in some cases. Now, I loved it. Yeah. I enjoyed the heck out of it, but we didn't go on to the next season. We basically got the show, it aired 6 times, and then that was it. And it was the greatest thing that ever happened. I wouldn't be here if I still had that show.
You wouldn't be here?
Not in this capacity.
In the capacity of what you're doing with money and so forth, if you were staying on that show right there.
I wouldn't be helping as many people as I'm able to help today.
Interesting, man. Chris, let's go back into the credit card example you were giving. As I was sitting here thinking about it, you were talking about you're $10,000 in debt. Let's say that I'm your customer, right? And I've got $10,000 here in cash, right, in my savings account. Are you saying that I shouldn't take the $10,000 and pay off my credit card, and I should put it in the insurance instead?
Right, and that from the surface doesn't make sense.
Yeah, it doesn't make sense.
You haven't been taught how money works.
Right.
So somebody's got 10 grand and they got 10,000 in credit card debt. And they're making let's just call it a $200 a month payment to that credit card company at 20%. So the most logical thing most people think is take the 10 grand, pay the credit card off, and now I got $200 to go below, right? That's kind of what you think. But when you give up your 10 grand, what did you just gave up your earning potential on that 10,000 that you had. Once you give that to the credit card company, that money's gone from your family forever.
You're saying you're not earning anything else with that $10,000?
No, it's gone. You just gave it to the credit card company. Okay. Only thing you now got is $200, right? Now you got $200 a month. Do you want 10 grand for an opportunity, or do you want $200 a month?
Right.
Right? But what if you could have both? What if you could have $10,000? This is this infinite banking. You got 10 grand, okay? You take your money from your savings, you put it into the infinite banking. Then, and that's just changing one thing. So instead of giving it to the credit card first, we put it into this specially designed whole life.
Okay.
Then what we do is we take the money out of this specially designed whole life and we pay off Visa.
Okay.
So we did the same thing.
You still accomplish the same thing.
We accomplished the same thing, but there's one very, very different thing here.
Okay.
That 10,000 that you deposited into your specially designed whole life, the infinite banking policy, that for the rest of your life until the day you graduate will always make uninterrupted compound interest at 4%. Never, ever not make money, but even though you took the money out. Because remember, you didn't take your money out.
Right.
The insurance company made you a loan for 10 grand, and they used your 10 grand that's in your account earning 4% as collateral. That's all your money did, is it collateralized the loan from the insurance company. Then you took that 10 grand, you paid Visa off. Now, that you used to give them, you never thought anything of it, because if you didn't pay them, they hit your credit. They would hit you pretty hard if you didn't make that payment. You no longer have to make that payment anymore. But now, if you were a bank, what would you do? You'd be an honest banker. You would take that $200 and you would pay your loan that you just took back from your policy, right?
Okay.
So take that $200 that you used to give to Visa. Paying that $10,000 loan back, which means every $200 payment you make back to yourself is $200 you now have to use the next day.
To borrow it again.
You could just take it right back out again.
Is there a certain loan amount you can't borrow below or up to?
Well, you can only borrow up to the amount you have in your account, which is the amount of your deposits plus the interest and dividends you've earned. So a lot of people, want to think with this system that they can borrow from their death benefit. So if they got $1 million death benefit, that they can just take $1 million.
Right.
No.
We're talking cash value.
Cash value. Right. That's what you can borrow against.
Is the reason the insurance company's okay with this? You say is because there is a death benefit. When you put that $10,000 in there, you're creating a death benefit as well. So when they loan you that money, if you didn't pay it back to them, they're going to take out the death benefit?
Good question. So the death benefit, when you took the contract out, right, when we set the plan up, there's people would think the loan I take, if I don't pay it back, decreases my death benefit. Wouldn't I eventually run out of death benefit? What they don't know is every deposit you make increases your death benefit. So you make a deposit grand or $500 a month, whatever you decide you want to do, because you can deposit any amount you want. Your death benefit's going to go up by a multiple. Okay. There's a multiplier that basically increases your death benefit for every deposit. So over the time, if you're making deposits into this system, this infinite banking policy, every time your death benefit goes up. So when you're taking money out as loans, you're taking it off of a higher death benefit each time.
And then when you pay that money back, the $200 a month, for example,
you're increasing cash value and your death benefit.
And up again.
Right.
But it's giving the insurance company the security and the flexibility to loan that money back out to you.
Correct.
Money's getting, their death benefit is growing, which is where their collateral, if you will, where they can take it back out if they need to.
Yeah, the insurance companies will never allow you to take more money out than you have in death benefit, because obviously that's what they're looking at. If you got all these loans, the loans can't exceed the death benefit.
Okay, two questions here for you. I find it super, super intriguing what you're talking about, right? Like, there's this whole new angle of money. Two follow-up questions here for you. One is, okay, we're talking about $10,000 and $5,000. But what if someone's listening right now that says, hey man, I've got a business that makes me $5 million a year. Okay. Can a company that makes $5 million a year, or a person that makes $5 million a year, play the same game?
Yes, we do it. But the problem with COVID, with what we're in now, the insurance companies capped out your deposits to $1 million a year.
Really, because of COVID?
Yep. So well, because they know what they're paying. They're paying 4%. Is you getting 4% anywhere else? Chances are, like even the stock market's losing. So now the insurance companies want to limit the amount of money people are depositing million bucks.
Well, do you think it'll go back to 5 million?
I might. I don't know. I can't.
So
predict
last
the
year was
future,
$5 million.
Right.
Was the max you could deposit in?
Yeah, last year was 5 million, and it's company specific. I'm referring to one specific ginormous mutually owned company
that you guys use a lot, probably.
Well, we use 4. There's 10 that we can use. We use 4 of the 10. So
what if? So you could deposit $1 into that policy and do the exact same game that's with 5 million, 10,000.
Yep.
So on a bigger level, if I deposited $5 million in, and I wanted to turn around and buy a building that I wanted $2 million back of it, I could take that $2 million back out and go buy a building with it.
Absolutely.
A commercial apartment or something like
Absolutely.
that. And then take that money. So as my $5 million, I took out $2 million of it. As that $5 million sits there, it's still making me that 4% plus dividends at the end of the year. And my $2 million is out owning real estate, and I can either take the rent from that, maybe a tenant, and pay it back over here as well?
You could do whatever you want.
Or keep it out.
You got to remember.
I don't have to pay it back that year.
You're the bank. So you call your own terms. When you go take a loan from a bank, they call the terms.
Right.
You're the bank here. So now you determine your own terms. So like in my practice, what I do is my banking policy, I'll take money out and I do a lot of private lending with my money, okay? I lend that money out. But let's say I was using it to buy real estate. I take a loan from my policy and I lend that money to my LLC.
Right.
I literally do a promissory note from my LLC back to myself. And I charge my LLC 6%.
Right.
Because I know that if I went to the bank's going to charge me 6%. So why not mimic what the bank does and pay the 6% to myself instead of giving it to the bank?
Now, I know that like well, let me hit my second question with you. Can you deposit like random money? On a deposit $500, $3,000 next month. On a deposit $9,000. Can you deposit random numbers, or is it like you got to set it from the beginning?
Well, you can make random payments, but you're always presetting it from the beginning. So if you set it up to put $1 million a year in, that million is going to be your ceiling. You can never go higher than that. But even if it was
put more in than $1 million.
Never more than $1 million. So let's say it's 100 grand. You set it up to be a year. That 100 is your max you can ever put in. There are IRS rules. So the rules are called the MEX 7 payment. And determine when you set the plans, the way we build them, we're build you right underneath that IRS rule. Meaning if it's 100 grand or $1 million, doesn't matter, that's your max. You can deposit less. Always put less in than what you set it up, but you can never put more. So now your question, can I make random deposits throughout the year? Sure, as long as it doesn't exceed the max that you set your for that year.
Now, is there a difference in, there is like Roth and so forth, right, where you can deposit or contribute a certain amount to it, but let's say that someone with a lot of money, right, let's do this, let's say someone pulled out $1 million, again, went and bought a commercial property that year, and their policy was at $1 million. They sold this, they flipped it or something, this apartment building, and they ended up making $3 million. And they want to take the whole $3 million that they made of profit, right, their $1 million plus 2 of profit, and put that whole thing back in that same policy. Can they do that, or is it capped at that $1 million?
It's capped at that $1 million. Now they could put in the next year, they could put another $1 million in.
Right.
Plus they could repay the $1 million they took out, but that's it. Now they got an extra $1 million that they don't know what to do with. Great. Start your second banking policy. So just
you could have multiple policies.
I have 6. I'm going on my 7th, and my mentor has 19
different infinite banking insurance policies.
And people are like, well, why would you need more than one? You got to start the second one.
Right.
There is not one person that will use this banking system that will ever just have one policy. Taking back, giving everybody else, now you've got more money. You need to make more money. You just need to take back the money that you're giving away to everybody else, because that's what we do. So as you want to put more in, you can't put more into the plan. There is, it's called the human life value, but that's kind of a tough number to hit. It basically is in your lifetime, based on your assets, how much money do you have the potential to earn and be worth. The companies can figure that out, and it's called your human life value. So you can buy as human life value keeps going up
as well. And you're saying someone like a Walt Disney used this concept build out Walt Disney World?
Absolutely. He had a New York life policy back during the Great Depression. And if you read his book or watch his movie, it's right in there. During that depression, everything got wiped out. The banks were wiped out. Wall Street got wiped out. There was no money. But guess what was money in?
Insurance.
Mutually owned insurance companies.
One of my questions I have for you is that insurance, I was reading some articles about, when I was to interview you, insurance companies have outlasted banks in some like the depressions and so forth, that insurance companies didn't fail like banks have failed.
Nope. And it's proven fact that insurance companies are some of the strongest and most well-suited financial institutions that there is. I mean, during recessionary periods, and this is something a lot of people always ask me, well, yeah, but if we go into another depression or another recession, is my money going to be safe? Absolutely, same way it was safe back in the Great Depression. Insurance companies actually can make more money and do better during recessionary periods because they can move their money into assets at a lower rate. They can make more money on all their surplus money.
So even if it goes in recession, though, they're still making the 4%?
Absolutely. You're actually guaranteed.
Asset protection side of it. I've interviewed some attorneys. I've interviewed. How does is this protected? Do I need to put it inside of an LLC? How does that work?
I'm glad that you brought up attorneys. Attorneys love this for that reason. So that has never had its valve pierced, right? So wealthy people, like we talked about the Rockefellers, right? Why did any money they put into this system, if they were to be sued, this can't be pierced. He did, or
from, right, Buffalo?
That's where I'm from, and he did or did not do some awful things, and because of that, landed himself in jail and got sued more times than I think any human being will ever be sued in history. And in all those lawsuits, he lost many of them, and you know, you would think net worth, still a multimillionaire. How can that be? Like, what did he do with his money? Well, his advisors were smart, and they moved his money into these. And it takes a little digging to find that, but you can figure it out. So
you're saying even though O.J. Simpson lost the lawsuit, got a judgment against them. I think I read one time he had at one point $150 million judgment against him. You're saying that judgment cannot pierce the veil of the insurance company?
No, they're protected from judgments and lawsuits. You know, the insurance policy itself, the money you have in it, is protected. For New York, the lovely state that I live in, it's the only state that has been pierced.
So let me give you a hypothetical here, right? Because I know that yesterday I'm just thinking about when I go to attorneys, they always talk about is like fraudulent conveyances, which happens a lot. Could borrow this, whatever, $500,000 to go flip a house in New York or something, and something happens and you're getting sued from the money. Can they, because it came from the insurance, could they then pierce that and come back and get the money, more money from the insurance policy there?
No, but whatever they bought with that money, they probably could take.
Yeah, that's going to be outside the house, outside of the policy.
They're protected.
But even though the $500,000 came from the policy, they couldn't then trace it back and say, well, you actually owe me $4 million for this judgment, therefore it came from the policy. I want the $4 million that you do have.
That I live. That's the only state where that's actually happened.
Incredible. That
yeah,
that's you're like the machine on this infinite banking, and then you stay there.
Comes down to one person that
on the asset protection. Does can you make a life benefit? Would you push that death benefit? Do you set that up to go to
be a trust as well, two different trusts.
Wow.
So one could be, revocable, and the other could be an irrevocable for total asset protection. Yeah. So you can do all sorts of very neat things like, let's go, this stuff gets complicated. Rockefellers, in any wealthy family, they have these policies. No question about it. They call it privatized banking. And they just keep putting money in, and then what happens? Why do the wealthy never ever seem to make less money or have less? Well, it's impossible. That generation spend their whole life, and then when one of them graduates back from the insurance company,
just circling back
over and more, and it's all tax-free.
It's tax-free.
We didn't even talk about the tax.
Well, we got to talk about that side of it now. What's the tax-free side?
People know that a death benefit in a life insurance contract is paid out tax-free in most cases, not all, but most cases.
Okay.
So if that's paid out tax-free, when you're using this system, taking loans So loans are never taxed.
Okay.
Because remember, they have to be paid back. But how can the loan be paid back in this? Well, one, you can pay it back, which is you being an honest banker. Or two, when you graduate, that death benefit is paid out, but it's net the loans. So when you're using this money, including all the growth, all the dividends, if it's properly structured, which we know how to do, it's all tax-free.
It's
every
tax-free.
penny of it.
That's incredible. So, but the money that, let's say, give you an example on the tax-free side. Let's say you pulled out, again, let's go back to $500,000. You had $500,000 cash value in there. You pulled out $500,000, let's just say. You bought ABC apartment. When you're paying yourself back, let's say 6% of interest that you were charging yourself, is that 6% tax-free?
No, that's taxed.
That's taxed.
That's taxed.
That because it came out. Right.
So when my LLC pays me back, that 6% interest that it's LLC is a flow through. I mean, depending on how your corporate structure is, but I'm getting a write-off in the LLC and I'm paying tax on a personal side. The two negate one another.
Right. That's incredible. And then the big one is, of course, the death benefit. Go back to the Rockefellers. When they get a death benefit, when someone graduates, you call it, when someone of maybe $9 million death benefit or whatever it is that's left over, whatever the chunk it is.
I mean, there's rare things that you can do wrong that would make that taxable, but yeah, in most cases, it's always taxable.
I know this sounds, in an interview, and we got to wrap this up, but it sounds it is incredible. But I know you're not explaining all of it in hyper detail right now. It's big picture stuff. But if someone wanted to know more about it from you right now, what's the best place for someone?
Is one place, but we have a video that teaches this entire thing.
Okay.
So I could put the link up. I can give you the link. It's moneyschoolrei.com/TMM. So the money multiplier.
Okay.
And that will show them exactly how this works.
And that's the website they go to, plus a video they can watch as well.
That is correct.
Teaching all this stuff.
That's all it does. Is just teach. That's all we do.
You can buy anything. You can buy houses, stocks. You can buy anything you want as an investment out of it.
Real quick, just a little sidebar.
Yeah.
So the stock market right to great levels. Well, you know what I did? When it fell, I went to my one banking policy that had money. I took a loan, and I took that money, I put it into my brokerage account. Things, not making stock recommendations, but that's what I did with my money. And how did that pan out? And unfortunately, I did sell a few of them, which I probably shouldn't have sold the one, but I took that money and I just paid my policy.
Creating more interest, compounded interest for you, and your death benefit kept going up again as well.
Think of that vending machine. There's never a day that you're going to have less money in your banking system the day before, because it's impossible. That money continually every year or every day it really is. So
and that's infinite banking in a whole right there.
It
has tax benefits, it has asset protection benefits, and it has compounding interest benefits as well.
Mm-hmm.
And
control.
Wealthy families love this stuff. Just not wealthy families. Anybody watching could go do this here.
Anybody.
It doesn't have to be wealthy.
If you can fog a mirror and say hello, you can probably.
You can start this with.
You do have to get qualified, so you have to qualify.
Just like a regular life insurance as well.
Yep.
But you can start this with $10,000 if you want to.
Yeah, you could start it with $500 a month.
$500 a month.
Minimum would be $10. If I wanted to do one, my minimum is $420 a month.
That you have to pay.
And a lot of people think, oh, I'm too old for this.
Right.
No. I mean, when you get into your 70s, it gets a little bit tougher, but it doesn't matter. The only thing that happens as you get older, your death benefit's going to be lower.
Yeah.
It's the only change. Cash will be the same.
Started this was because, money is blank. Money means different. Office, what you have. We have these signs all over the great photo of you, and it's got the blank here. Money is blank. So that's all important in your life because you teach it nonstop. So I'm very intrigued by your answer. What I want to do is I want you to write the answer here, whether it be a word or write that here. I want you to sign it here, and then I want to talk to you about why money is that to you. Let me get you
this is easy.
It's easy one for you?
Yes.
Get you a Sharpie here. There you go. Write down what money is to Chris Naugle. While you're doing that, what is a social media platform people could find you on?
Instagram. I love Instagram or Facebook, but Instagram is my #1.
Very good. And was that with your name, Chris Naugle?
Yep.
As well?
And Chris _ permission slip.
Oh my gosh, no one has ever said this. I love it when people say different things, man. I absolutely love it. It's a good one. So he said, money is my permission slip. Bro, that is a really, really good one.
Thank you.
All right, but I want to know what it means to you. Why did you say my permission slip?
So, you know, our whole lives we've been taught not. My whole family was brought up that. But money and my permission slip to live the life that I want. So how I've lived my entire life is I've always known what my perfect day looks like. I wake up to the second I go down. I don't have time, but I could tell you exactly what that perfect day looks like. Well, money is the only way that that perfect day happens for me. Yeah. So money is my permission slip to go to a surf trip. Money is my permission slip to come out to Park City and go snowboard. Money is my permission slip to retire. Money is my permission slip.
That is a great one, dude. Awesome, awesome answer there. Chris, I've loved having this show, man. I want to get you back sometime. This is a lot of stuff we could cover in there, and absolutely great to do the show for you guys.